Hi, my name is Nick. Today I'm going to talk about my capital budgeting simulation scenario B. So for this one, my company make 678.62 of AVP, and I think this by far this the one that I like the most. So I'm gonna talk about it. And so on this dashboard page, as you can see, it is the cash flow by division and revenue by division charts. So from this you can see licensing make most of the cash flow, and the next item on the list is retail, and after that is production. However, when you look at revenue by division, retails and production seems to be making seems to be adding up for more money than licensing, and that is because my investment I invested most on production and retail instead of licensing, and I will tell you more about why I chose that decision instead of going all into licensing. So that is revenue by division. Next is operation profit by division, and as you can see, the same similarity between the cash flow and operating profit by division. It is licensing, they make most of the profit. So this is the total assets by division. So like I said earlier, I focus on production and retail, so production would be taking the most in here. And my revenue, my operation income, my net income for over the years all exceeded the forecast amount. So that is why I like this simulation the best. And this one is my updates of my projects so far. So for now, I will go into more details and discuss about the projects, and as well as why I chose the projects and how I use the theories and the things we talk about in class to make my decisions. So this is my projects. So like I said earlier, I focus most on production and retail, and because um, we have different choices for like I think there are like 27 projects overall, and amongst those they have different choices they have to make, and most of them consist of growth projects as well as some types of cost reduction or improvement projects as well. But all in all, they consist most of independent projects, and some of them are also mutually exclusive projects. So what I mean by them is that for independent, you just have to choose to invest them in them or not, and for mutually exclusive, you have to look at or compare the number between two projects together. So for those number, I will show it later in the later parts. So for this page, it is the project updates. As I'm gonna show you how my projects goes in this one. They for like 2009, I invest the most, and then I took a pause in 2010, and then I invested in 2011 and 2012 the most. So why I chose these projects? I consider the basic or like the nature of the projects. So some of them are like growth projects or expansion. On some of them just helping with like expanding the market to another area, or just to improve um, the control system of your company. So let me go into details and see how I use the capital budgeting simulation to make these decisions based on several numbers. So let's start with the income statement and the balance sheet. So because I have completed this simulation, it will show the future projections of my projects so far. So from this income statement, I would take a most of my focus and to compare the number between the years with the net income in the income statement. So as you can see, for future projection, in my net income will take an increase every year. And so move on to the assets. Assets numbers will show how much or how liquidity my company is right now, and how I can use the number to choose between um, investing in production or investing in retails. So that is the company consolidated as a whole. So like they will show production, retails, and licensing as a whole. So to break it down or go into details, they have production, and they just have the kind of like the same numbers. They break down into divisions. So for productions, they shows just the number of production, and likewise for retails and for licensings. So let's switch back to the company as a whole and look more into the balance sheet. And for this one, let's take a look at take liabilities as an example. So every year we have kind of like a long-term debt to pay, and for this when I look at this number, if my future projections would be from my company would be a lot in debt, I would have to change some of the investment to make that number go down a bit instead of just going too high or just like that. So these are the future projections. So I'm gonna show you what my decisions was like, and for that I will go to the historical financials tabs, and this will show us like income statement and balance sheet that I have chosen for the projects so far from 2009 to 2014 over the past 5 years. So as I said earlier, for income statement, I will look at net income. So net income, I started at 12.49, and in 2010 go down to 11.18, and that doesn't sound bad at all, because that year I invested a lot of things, a lot of new things into that. So it will go down, but it will go up later. As you can see, in current years it went down into 11.18, but it went up to 25.18 as in 2014. And so in the balance sheet, as I said earlier, my projects, I focused them on production. So the gross property, plants and equipment will go down a bit in 2010, because I invested a lot in that year, but they will go up. And in 2014 it is 309.80, and because for this accumulated depreciation to go up, they will go up as this number go up. So this high number will be this number will be will be subtracted by this number to make the net property, plant and equipment, or PP&E. So this will show the actual amount. So when we read into the balance sheet or read in like income statement, we usually take a look at the net, because they have already taken out the depreciations, or taken out the taxes, or taken out the everything that would be subtracted into your actual amount. And before I go into more details of why I chose which projects among like a total of 27 projects, let me discuss more about the cash flow statement. So for cash flow, we would